What is going on with the markets, everybody? In today's video, we are going to be unearthing, unpacking, lifting up the hood of my 100% cover call ETF portfolio. And of course, we'll do this. We'll also break into like what's going on in the marketplace. Let's see what's going on with funds like BIGY and HHIS, as those funds have certainly been hit by the recent pullback in tech. But as always, with a video like this, I want to show you what my portfolio looks like, my distributions, growth over time, projected dividends for the month upcoming, as well as how my portfolio has performed against other indexes, and just show you all how distributions have grown over time as an income investor, someone who's invested 100% in cover call ETFs. And I'll also hopefully shed some light on, or even more light, on why I invest the way I do. Why do I pick the funds that I do? Well, stick around because that's exactly what you're going to find out here. So we're going to start with the cover call ETF ALLSTAR tracker. I have a tab here that's called My Portfolio, and you can get this for yourself in the description below. Tons of tools, bringing together info from the fund manager websites and places like Google Finance into one spot, so you don't have to have like a million tabs open like you see up here. All in one place that you can filter through, and there's over 300 funds. So always got to put the plug in there for that special year-end sale going on for that, but just check out the description, pinned comments below. Okay, let's get into yields. First thing, this is always the most interesting part. That's why it's highlighted boldly. As you can see on the sides here, if you compare them, this is the market yields right now. So if you were to buy any one of these funds right now, this is exactly the kind of yield you would be looking at, the forward-looking 12-month yield. If the distribution was to be stable for the next 12 months, this is the kind of yield that you can expect if you bought in today. But since a bunch of these positions, I've been in them for some time, some are, well, a bunch of them are a lot higher than what the market yields are today, right? Because of course I bought in at a lower price, so therefore my yield is naturally going to be higher, especially as the market ticks upward. So I mean, my biggest yield is BIGY at 28.91%. Market yield currently a little bit better than that, but my lowest one is what would that be? HDIF at 10.83%. I, as an income investor, am typically interested in 10% plus yields. I'm always excited for 10% plus, but as soon as you start dipping down into the 8s, 9s, not so much. So let's move along over to portfolio value. So going off by this, it's $441,580. As far as market price or my average market gains are concerned, I'm up about $8,216. Now, if it wasn't for these two BIGY positions, I'll get into why I have two different positions very shortly here. I would be, without BIGY in there, I'd be up like $21,000. But of course, I have that 8216 in there as a market gain. As far as price returns, to see it as a percentage, this is what it exactly looks like. The top one being QQCL at 14.63%, just edging out HYLD at 14.14 or 15%. HYLD is the OG in my portfolio. I've had it for about 3 years, and QQCL I bought earlier this year. Nonetheless, all of these returns are within a range that I'm quite comfortable with. I don't usually like seeing funds just absolutely run away with share price. I often call that dead money. I'm an income investor. I want money generating income for me on a monthly basis, right? So if a fund just starts running away with price, that to me, that's money that's not working for me to earn income. So if I have the chance to sell it off to get into something maybe better. Maybe it serves, maybe there's just simply a fund that's similarly structured, and I can get into that, maybe slightly higher yield, maybe a little more leverage in there. Then I might do that. But anyway, these are all within a range that I'm quite happy with. And honestly, these funds, because they're index-based, proxy index-based, some sector funds, my portfolio really has matured over time to basically become what it is now, which is something I'm really happy with. Very minor changes at this point. And then we get into total returns. Of course, HYLD being on my portfolio the longest, it sits at 48.74%. BMAX and HDIF, these two are also, I would say they're the next oldest funds. I've had them in my portfolio for a couple of years, which might be kind of surprising because they are the lowest yielders in my portfolio. But I honestly, I really like these funds. They serve as a bit of a defensive backbone of the portfolio. As far as a portfolio with leverage is concerned, certainly if there was no leverage, it would certainly be more defensive. But if we're going to be talking about funds with leverage, these two are certainly in that conversation. And anyway, so they will stay there. They remain there. I have no plans on changing those out. And of course, I have these other funds I haven't had as long. QQCL, USCL, bought that earlier this year, and of course, some funds at the top here, like Bank, UTES, ECHI, and ENCL. These funds are sector-based. They're in a taxable account. In Canada, I would much prefer just investing in the sectors versus the indexes. I find it, I get what I really want, which is financials, utilities, energy. These are the home bias sectors of Canada. Of course, ECHI gives us exposure on a concentrated level to single stock Canadian cover call ETFs, but you get things like uranium in there, gold in there. You get our darling tech company, which is Shopify. You get a couple of banks. You get CN Rail. So you get a bunch of stuff in there that I really like. Haven't had it that long. ECHI's been out since August, I want to say. And total return 7.36%, not too shabby. As far as projected distributions for December, we're looking at, I did not calculate everything there. Is $7,332. Now I'm looking at Wealthica right now, and this shows how my distributions have grown over time. You can see last month I made about $7,075. I think I made honestly, I think I made a little bit more than that. But nonetheless, my distributions did not drop. It's just I'm waiting for the next BIGY payout, which is paid out twice a month. So once I have that, that will put me at that 73.32. But as far as strategy is concerned, you can see earlier in my sort of early cover call investing days, I was into funds that were pretty sporadic. Things like HYLD sometimes paid out twice a month, sometimes just paid out once, sometimes it skipped a month. Honestly, that just was no bueno for me. I did not like that, and that's why you see how sporadic it was in the beginning here. Come August of 2023, that's when I decided to just focus on funds that would be stable. And as you can see, the income just started to slowly grow from there. And of course, over time, it starts to pick up speed. And that's why you see how incredibly, it's honestly very satisfying seeing this kind of growth and focusing on stable distributions. Yes, you see it kind of rocket up here. This is because I sold my condo, got into a rental, and I put a bunch of that condo money to good use. So it jumps from $2,840 a month all the way up to $4,856 a month. And then we see this next giant increase. Well, I can't sell what I'm renting. What happened here? It was around this time, September, that basically what had happened was my wife and I, we found out that she was pregnant with our soon to be fourth child, first daughter. I got three sons currently, so first daughter incoming in March, and I wanted to take a bunch of time off with the birth of my fourth. I wasn't really able to do that with the other kids. I took like a month off at the maximum, but I saw this as an opportunity to step away from my job for up to 18 months. I have job protection for that amount of time since I live in BC, Canada. And honestly, I am very happy and willing to give up 18 months of potential compounding and putting that money to work to spend more time with my newborn daughter, with my other kids, with my wife, focus on the channel, focus on other business opportunities, and see if I can actually make this work for the long haul, not just so above and beyond 18 months. And I think, honestly, with job protection in the backdrop, like, why wouldn't you do that? My original goal was really to just potentially be retired at 45, like truly build up a giant nest egg and walk away at 45. But that, for all I know, that could be at 36, 37. I don't know, but we're gonna find out for sure, and you guys are gonna stick around for the journey as long as you hit all the buttons of the like and subscribe variety. That's the only way that you can really find out what happens with this story. So in order to do that, to take this time off, I needed to do basically the only thing that I really can do, which is up the yield. So for one, I took more of my portfolio, concentrated down into funds like HHIS and BIGY to boost up the yield. I also got into some margin. So basically around this point, I would say at this point here, I had a forecast of $60,000 roughly that I'd make over the next year. I decided to bring those distributions forward to put to work now to get ready for when I step away in March. So brought forward $60,000. I put that into things like ENCL, UTES, bank, and HDIF. I just wanted it for the tax efficiency. I wanted it for the yield, and I just wanted to be just a nice that counterweight to the big tech stuff that you see in concentration with HHIS and BIGY. So those were the two big reasons why I did that. So that's why you see things like at $5,000 a month all the way up to $7,075. Now, another sort of hot topic is should you be using margin at all? Now that I've been renting for a little bit, and obviously many other people in Canada and of course across the US are finding it very difficult to buy into homes, and it seems like it's been getting out of reach. It's been honestly, as far as I'm concerned, and again, I'm turning 36. When I was 26, like honestly, in my target neighborhood here in Vancouver, the thought of owning a house was already way out of reach, and the townhouse, even almost 10 years ago, was debatably out of reach at the time. Things really started to take off around 2016. Like that truly was when things took off. I remember watching real estate over the summertime, and things rocketed out of control. I don't know really what happened in 2016, but I don't know. Someone can maybe point that out in the comments if they know why. But 2016, summertime, things blasted off here in Vancouver, and I have no idea why. I remember a 3-bedroom, 2-bathroom townhouse, 13 to 1,400 square feet in my target neighborhood was like $323,000. At that point in time, of course, I could afford that, but at the time, my wife and I were still paying off some debts that we brought into our marriage at the time. We wanted to pay those off first. But literally, they were all, anything that I had filtered under 400 grand, it all just disappeared over the course of one summer. Totally bizarre. But anyway, now it's even worse now. So there's a debate now, I would say, that if you're renting, how else can you build equity? Right? A mortgage is just a game of semantics. It's just mortgage is debt, leverage is debt, margin is debt. It's just it's just, we see mortgages as safe, even though it's like, it's like 8 times our income. We're probably paying it off for, for forever. Meanwhile, margin is, I would say, I think most people see it as riskier than a mortgage, but it's really just based off of your portfolio value. It's never going to be, say, 5 times your income. It's going to be a percentage of your portfolio, and more specifically your taxable account. And then maybe if you link it, if your brokerage allows you to link it to, say, things like another account like the TFSA, which for me, Wealthsimple does that. And I'm using currently, if we're talking about everything, it's under 15% of my entire portfolio of everything. Now, of the 2 accounts, it's about 40%. So I'd kind of like to get that number down a little bit more. So I borrowed $60,000. I'm gonna let the portfolio grow as best I can and get that number down a little bit more before I ever really start entertaining taking on a little bit more. But no plans to currently pay it off. Just I want to use that to compound for now, then use that income that it's generating to help pay for just the lifestyle once baby comes along. So that's kind of my plan in a nutshell with that. Let's check out some other insights, other unique insights, like what does my portfolio look like versus other indexes? Well, on a price performance level, it looks pretty miserable, especially if you're not as familiar with income investing. Of course, if you're an income investor, price return is, I would say, it comes secondary. It does. I'm focused on compounding my income like you all had seen here. This is what I'm focused on. And actually, we'll get to the comparisons with the index. I should have shown you all this. Which is distributions over time and just how things have increased. So I want to show you all this, which is, as you can see month over month, you can see how my income has compounded over time. I mean, to get this kind of compounding on a month over month basis with share price, portfolio, value, I would say a little bit tougher to do, but it's certainly much more predictable when you're focused on income. Again, income is still a strong part of the total return, price and distributions together. Distributions, dividends, you guys will use these words interchangeably. Stocks pay out dividends, ETFs pay out distributions, just so that we're clear for the newer investors out there. But covered call ETFs prioritize taking more of the total return through the distributions and not as much through the share price. Sometimes not even at all, which I think is a bit dangerous when our total return is basically all in that income bucket. I like it sort of more on a scale of, let's call it, it's not an exact science, but I'll just use this as an example. 75%, maybe 70, 80%, the total returns come from income. The other 20% is coming from share price. Okay, don't quote me on that. That's just to give you kind of capture an idea of how investing in covered calls work and how to kind of think about them, prioritize them. But this is what month over month compounding income actually looks like as a percentage, which again I think is much more easier to predict because your contributions are working into that, are factoring into that predictability. Natural distribution increases factor into that. Reinvestments factor into that. So you have these different buckets that help grow predictability, give you the confidence to build up that greater income so that you potentially can take off time. You can, so for me, this is what all of this work has honestly led to, which, I mean, I'll be fairly transparent here. Fourth child, it was a surprise. But with that surprise opened up an opportunity I wasn't even thinking about. So I changed gears And I think it's for sure it's a worthwhile one, and I'm definitely going to take it. I have the confidence and the conviction to take it. I will take it no matter what anyone says. So really important to give you guys all an example of that. I post these income reports every single month if you follow the channel, and of course weekly I post what my portfolio is doing. You can see how my portfolio stacks up against other indexes. You can see income made for the year, portfolio value. So every single week, and I just hit post number 100 on a weekly basis. So I think that's pretty incredible, staying consistent that way, so you can at least scroll through this to see how my portfolio has done overall. All right, let's move back to the indexes here, give you guys a little bit of a sample as to how my portfolio has performed against other indexes year to date. So we're at the S&P 500. Again, if we're just looking at price, it looks kind of abysmal, but once you factor in price, right, which is what you see here, 3.43%, then you add in the dividends, which jumps that total return up to 23.43%. Now it's making the S&P 500 look kind of sad. Again, my goal is not to beat the S&P 500. My goal is not to just have this huge portfolio value. Again, I'm focused on income, compounding income. This is just a fun thing every investor naturally likes to do. We all like to compare our portfolios against other indexes. So how would it perform against the NASDAQ 100? It's doing better than the S&P, but again, I'm up 23.43% to 17.54%. We'll check out the TSX 60. This is Canada's S&P 500. And it's had a strong year despite tariffs, despite all the doom and gloom about Canada. I'm not going to be a doomer about Canada. I'm going to keep investing a portion of my portfolio in Canada, roughly a third. I really want my RSP and my TFSA to be American focused for the growth end of things. I understand growth kind of sounds like an oxymoron coming from an income investor, but we can get growth. We can, but it also depends on the structure of the funds. A lot of these cover call ETFs that are built in Canada are hybrid approaches, allowing half of your portfolio. It's almost as if half your portfolio it acts like it never had any cover calls on it, and then the other half, of course, has the cover call strategy on it, which is something I really appreciate. So it makes me kind of think of myself as a hybrid investor of sorts. And of course, basically half your portfolio is getting exposed to these amazing strategies that we see in things like HYLD and BMAX and HHIS and BIGY, and many fantastic products out there that we are really blessed with as investors. So anyway, total return year to date, it's beating out all these indexes. I know in the community there's been a lot more, and there always will be, right? Just more talk about, cover calls are trash and they underperform their underlying. And anyway, this conversation has been going on for years and years at this point, as long as I've been doing this. But at the end of the day, when it comes to the data, it is important to see how a real trained in the wild retail investor is actually doing and being transparent about it. That's what I try to do with all these posts that you see over here. And of course, by sharing videos like this, so you can actually see how a real investor is adapting to real situations, how I'm amalgamating my portfolio to be conscientious of defense like you see with those utility plays, maybe some concentrated funds like you see with BIGY and HHIS, and kind of put them into one spot together to get a portfolio performance like you see here. It comes with time, comes with experimentation, but let's face it, as humans, we're great at one thing: adaptation. We always have been, we always will be, and we cannot just be widgets stuck in one spot. Okay, so as far as real world examples are concerned, this is the real deal. I don't know, if someone says this stuff is fake, I don't know what to say. You got a tinfoil hat on. I think another interesting point, because I'm using Blossom, which is of course a wonderful social investing app. Really enjoy Blossom. I know the creators of Blossom and have gotten to meet them several times in person. But one part of this I really like is comparing my portfolio, the weightings, allocations to the average other Blossom investor. And I got to say, my portfolio looks really different from everybody else. As far as financials, I'm way ahead of everybody else. Technology is roughly in the same wheelhouse as everybody else. But then energy and utilities, I really have, I would say, a great appreciation for things that I feel like we just truly cannot live without. We need energy, we need the utilities, and I think it's going to say that I'm always going to have a much heavier reliance on these in the portfolio. Oh, oil just goes up and down always. It's not, it's not green and rising up to the right. And utility is just boring, steady Eddie. And anyway, so I think those top four are interesting to see just where my portfolio stacks up against everyone else. And of course, no fixed income. I'm a no fixed income kind of person. Although I don't mind it in a multi-asset strategy like we see with BMAX, right? I also don't really like gold, but I have gold and HYLD, and so I don't mind these, say, things I don't really like, but they're in they complement the overall portfolio, and sometimes in strong ways. Gold has complemented HYLD actually really well, so happy to have some light exposure to it for that surprise. As far as distributions are concerned, to see how much I've made over the years, we can see in 2021, made like $12. 2022, $5,333. 2023, $14,936. 2024, $23,741. And in 2025, I have made $42,888. I suspect I will level out just under $50,000 for this year. And then the forecast for next year is more like $85,000. So again, the income can increase quickly, but that's what I'm focused on. Anyway, you can see, well, that is certainly not my average yield. I can guarantee you that. That's like if all my portfolio was BMAX and HDIF, then I'd believe that, but not with the kind of exposure I have to BIGY and HHIS. So sometimes the Blossom stats, they got to reset at times to reflect a little bit more accurately. But anyway, a wonderful platform nonetheless. Okay, so we talked about pretty much everything about my portfolio. You've gotten an idea of kind of why I'm investing in the things that I'm invested in. I got 1/3 of my portfolio into concentrated tech stuff for the higher yields, which I do need, especially once baby comes and I'm taking off time from work, because I'm going to be living off of this stuff. I got another 1/3 roughly in the indexes and proxy index plays. So these would be the HYLDs, the USCLs, QQCLs, BMAX, HDIF. Those would be those plays. And then of course I have the Canadian stuff, which is a total contrast from everything else. They're sort of my, diversify, tax favorability. They're away from tech. And they offer up a bit of a volatility dampener, I would say, especially when tech is just going nuts in all directions. My Canadian exposure kind of helps limit that. And with time, I've kind of understood where I kind of actually get uncomfortable with volatility. And, when the market actually does go down, where I start to feel the cracks in the armor. So the Canadian stuff is there to just kind of help with that. But again, it comes with time, comes with understanding your own goals and just understanding these funds. Unfortunately, it's not like turning on a light switch and it's a eureka. You have eureka moments, but to understand yourself better with these kinds of investments, it's just a waiting game, and just keep learning. And it has nothing to do with being a genius. It's just time in the marketplace, just like these funds. Be in it for the long haul. You'll not just compound your returns, you're going to compound your education. I got to say, as I've compounded my education, which I would say has skyrocketed, 30, 50, 100 times, my portfolio has followed along with it. So don't think they're just separate things. Your education is going to help your portfolio do better. Let's talk about the market a little bit just to round out this video. What's going on in the world of investing right now? Why has the markets blown off? Why is everybody getting into a twist right now? Well, it really has to do with investors looking at a lot of the tech companies right now, and it's really kind of summed up in titles like this: the circular money problem at the heart of AI's biggest deal. So basically, what's going on is, let's say Microsoft invests $13 billion in OpenAI, right? The Chat GPT company. Then OpenAI goes around and buys a bunch of cloud computing stuff from Microsoft. So that's the idea of sort of the circular money. It's kind of filtering around all these companies. And finally, investors are kind of going, okay, we're kind of catching on here. We're a little worried at the moment. So that's what's going on there. Of course, I gotta show you guys this. I mean, things like the NASDAQ. You guys remember this period? What happened in April? Tariffs. And the market just took a good route back then. Guys, we have experienced this little boop, there's a little blip. And again, a lot of us are kind of getting into a twist about it. But I think that really just kind of comes down to a couple of funds where we're experiencing these heavier unrealized losses. Again, they're just paper losses. So that's going to be in things like the MAG 7, which again, not really seeing anything super crazy on the MAG 7 end of things. I thought by looking at, I didn't even know there was a MAG 7 index, but I'm not surprised there is. I'm not saying this is an ETF, it's just this is the index of the MAG 7. And again, I thought we would see more of a rout here, but we're not exactly seeing that. So where are we seeing it, especially as income investors? I think we're all kind of feeling a little bit of the heartthrob with, again, a couple funds. And that really, I think, has more to do with things like strategy. And more specifically, if you're an income investor in Canada, that's going to be MSTE, the Harvest MicroStrategy Enhance fund. This fund, with its 25% leverage, strategy is already levered up within. So it's Bitcoin levered exposure, then you add the 25% exposure, and then you get this, which is last month down 37.17%, the last six months down 63.35%, and I mean year to date, way down. Where does the bleeding stop? I don't know. I don't know what to tell you. I think as far as what I'm seeing from the social media end of things, there's very much of course, on one side of things, the people who are, whether it's anti-Bitcoin or just anti, call it memery investing, or hype investing, if you want to call it. They look at Michael Saylor and they're like, why do we call things a Ponzi scheme? Let's call it a Saylor scheme, right? That seems to be the from the crowd that's kind of just been waiting on a knife's edge to say, see, I told you so, Bitcoin. I don't have a dog in this game to hunt because I've never invested in MSTE. I've always stayed away from single stock cover call ETFs. Any single stock cover call. It doesn't matter how fabulous the company is. I like to stay in big diversified funds. But however, it is an interesting observation to see what's going on in this case. So I think income investors are experiencing this with MSTE. And strategy is also within BIGY. So is Coinbase, which again hasn't, maybe over the last month, hasn't experienced the biggest the big, like, okay, down 14% over the last month, roughly. But if you're invested in something like BIGY, well, you're exposed to strategy and Coinbase. That makes up 20% of the portfolio, and over a what is that? Over a a 1 week period, BIGY experiences an 8% loss, at least on just the price performance. If you factor in, say, over 1 month, and then with the total return over the past month, just down 2.16%. Again, not something to really get into a twist over, whether we're up a little bit, down a little bit. Total return helps us out to not get, I would say, as frustrated with the losses that we see here. The Mag 7, the Fangma companies, they're wonderful companies, fabulous companies. Hard to bet against these companies. Berkshire Hathaway just invested something like $4.3 billion in Alphabet, and that's one of the companies we're talking about here. So again, I think the market needed to simmer down a little bit. Investors needed to kind of cool off, and it's in situations like this where I think it does make us more resilient investors. I think we get complacent in the good times. I think we start to think a little bit harder about our portfolio construction when times are a little bit tougher. And I gotta say, from people that are invested for income, like people that are close to me, are saying that more naturally. They're saying, I shouldn't have been as exposed to strategy, even though it's had the hype. I just stay diversified because, as I like to say, diversification is the hedge against ignorance. And I got into ETFs because, honestly, I just do not want to spend all that time sifting through quarterly reports and what's this company about, what's my circle of competence. You know what my circle of competence is, which is an old Warren Buffett saying. My circle of competence is ETFs and is the macro environment, the big picture. When likely will tech take off? When will people rotate into more defensive sectors like utilities? I'm much more interested in that. It's much easier to swallow. So that's why I'm into more diversified stuff. I don't want to get too greedy with the single stock. Of course, concentration may yield higher results. It's never a guarantee, but certainly the more you concentrate you get, you have that opportunity. So I would say that that's kind of it for the market side of things. Now, if you enjoyed this portfolio overview, my analysis on the markets, then as always, hit all the buttons of the like and subscribe variety, and stay tuned for the next video.